It's hard to know exactly what to address because it's moving. It's moving on both sides of the Atlantic with Credit Suisse, UBS, maybe over there. We've still got New Republic and other issues here. So as an investor, what do you do in these circumstances?
Yeah, look, it's very difficult. Investing is always a challenge, but in these markets, it's even more difficult. Risk is hard to take right now because if we really don't know where to take the risk, it's very difficult to put the risk on. So I think right now in today's markets, probably investors shouldn't be committing more to a particular risk position. I'm not sure they should reduce their risk because it's hard to know where to reduce the risk. None of us thought the 2-year was going to rally 100 basis points in less than 7 days. That's a dramatic move. And none of us had any thought that, in fact, these banks were as unstable as they are. So I think at the present time, if I was investing incremental dollars, I'd probably have it in cash.
So as a practical matter, what we saw with Silicon Valley Bank and other places seemed to be a mismatch with respect to duration and respect to liquidity, as you had long-term treasuries and other securities matched up against deposits people could withdraw right away. Where might there be similar mismatches, do you think, in the system, either in the banking system or beyond the banking system?
No, I think that's an excellent point. I think one of the challenges that the world has, this is not just a U.S. issue, is that for 10+ years, interest rates have been very benign, inflation benign, volatility benign, and people have gotten comfortable with that. And so they've invested more money than they probably would historically into private assets, into private equity, into private credit, in places in which they don't have liquidity. And now that interest rates are much higher in the front end, that cost of that liquidity is actually significant. And what we're seeing is a disintermediation of cash moving to where you can get 5% in short rates, whereas before you were getting 0. So yes, it's happening in the banking system. It's happening any place that is actually benefited from very low rates and low volatility. It's happening in the insurance business, where actually people who have insurance policies are saying, well, if I actually terminate my insurance policy and buy a new one, or actually buy a public security like a bond, I might get a better return. So we're going to see this continue to roll through the economic environment, and it's not over yet, and it's going to continue.
Part of the problem is marking to market. We haven't had it obviously we've now learned the banking sector when it comes to some of these long-term treasuries. You've been on Wall Street Week before talking about in some of the private markets, private credit, private equity, things like that. How does that work its way through the system? Because sooner or later, if it's worth less, we have to recognize that.
Yeah, I think that's right. Look, what we sort of don't want is we don't want people with private assets to be forced to sell because they're not liquid. They ultimately will be sold at significant discounts, and the buyers of them are going to charge a lot for the liquidity. So it would be better if people who had those assets could hold them, but you're right, they're valued at rates or levels that are probably higher than what their actual value is. And so we have to sort of engineer a change over time. So foundations, endowments, pension plans, any investor that has a sizable amount of private equity or private capital is going to have to figure out where to take their incremental dollars and invest them in public securities. And I think another issue that people have is they spend out of these foundations or endowments. So if your private equity investment is not actually selling companies and producing cash, then you're going to have to take that cash from the public side, which is going to put more pressure on that unequal or imbalanced ratio. So I think this is, again, not going to get solved over the short run, and it could create some acute cases in which people have to sell these assets.
What does this tell the Fed? We've got a Fed meeting coming up next week. We had the ECB this week. Stay the course as it was anticipated with the 50 basis point increase. What does it say to the Fed? Does the Fed need to be worried about financial stability at this point?
The Fed is worried about financial stability. They've proved that over the weekend. They did exactly what they should have done, which was to stabilize the two banking situations that the FDIC took over, and the transaction that you discussed earlier, where large U.S. New York banks put money into First Republic. Having said that, inflation is still very high, and we have to think about the fact that inflation affects the broad economy, not just the banks. And if we don't continue to fight inflation, then the bill we're going to have to pay at the end is going to be even bigger. So I think that the liquidity that was created by the bank actions over the weekend created space for the Fed to actually continue to take rates up by 25 basis points. Will they continue to watch the banking situation more carefully? Of course they will. That could change in the future. If a systemic bank fails, that may actually change the Fed's position. But for right now, I think the Fed probably moves 25 basis points.
As I said, there's a lot of moving parts still, but if you were going to project right now for the medium term, not just the short term, but the medium term, would you expect the incremental investment dollar to be going to a different place? There's been a rapid growth in private credit, and private equity, which is a bit more opaque, as we've talked about before. Would you expect going forward investors would be a little less willing to put it in private and maybe stick with the public market?
Yeah, I do think the cost of liquidity has now gone up dramatically. And where it was kind of a no-brainer to put money in private assets, given what you would get in public assets, or certainly in short-dated public assets, that's changed dramatically. And so I do think on the margin for two reasons. One, the rebalancing issue we discussed, and two is the relative attractiveness of the yields of public securities versus private securities. I also think that there's going to be a reckoning in the private capital or the private credit world where the loans that have been made over the last 10 years in a very benign credit environment. People look at the credit history of those assets and see very few losses and feel comfortable with that. That could change. And if people then begin to understand, well, those populations of loans are not quite as free from credit risk as I thought, that will also make people think a little bit more about putting money in the public side versus the private side.
What does this mean for, if I can call it this, the real economy? I mean, for example, to be very direct with you, is a recession more likely today than it was a week ago?
Yes, to be very direct with you. I think that the Fed has been saying, again, since it started raising rates, they want to restrict financial conditions. If you restrict financial conditions, by definition, you have to slow growth. Of course, the Fed is trying to slow growth without creating a recession. That is a very hard thing to do. With the banking crisis, you're probably also seeing financial conditions both loosen as a result of the Fed's action, but also tighten as a result of regional banks husbanding their cash and not lending as aggressively and worrying more about credit risk and therefore on the margin probably not lending. So I suspect on the real economy, by the end of the year, there will be a significant slowing, potential recession, and that's what we need because we're not going to get inflation down unless that happens.